Hi there, I'm Jennifer Lee, Senior Economist at BMO Capital Markets Economics. Well, the last month or so has been quite interesting, a lot of changes. For starters, we have new residents at 24 Sussex Drive in Ottawa, or at least we will after all the renovations are completed. We view the Liberal government, the majority government, as a near-term positive. Well, for starters, of course, we won't be going to the polls anytime soon, at least for the next 4 years or so. But their planned spending, of course, at the cost of deficits for the next 4 years, their planned spending, if they are all fully implemented, could boost GDP next year in Canada to the tune of about, by the tune of about 0.5 percentage points. So we could see over 2.5% growth for Canadian GDP in 2016. And that obviously is good news. That gives the Bank of Canada some breathing room to stay on the sidelines and let rates stay on, or keep rates on hold for the next year and a bit. And if anything, also supports our call for the bank to be on hold for the rest of this year and next before moving to raise rates slightly in early 2017. As far as the Fed is concerned, again, it's been a very interesting story over the past month. We have seen a steady stream of, quite frankly, disappointing downbeat data. However, the Fed just met in late October for their second last policy meeting for the year. As expected, they stayed on hold. However, the Fed's press statement, was a little more hawkish than expected. Sure, they suggested that labor market growth was slowing a bit. However, they made references to global growth. Actually, they dropped all references to the global uncertainty and global financial market volatility. In September, they had said that all these global market concerns had the potential for hurting U.S. economic growth and putting downward pressure on inflation. And they dropped all those comments completely in October, but they did say that they will continue to monitor those developments. And here was the key. This is what made the press release even more hawkish than we were expecting. They inserted the phrase, "at its next meeting." They were referring to the next meeting in December, and then they said that they will continue to monitor all economic indicators as it relates to the employment outlook and as well as for the inflation on the inflation front. And at that point, they will judge whether or not it would be appropriate to raise the federal funds target rate at its next meeting. And that basically means that the December policy meeting is still very much a live meeting. We could very well see the Fed raise rates from emergency low levels on December 16th. And that's, of course, assuming that everything goes their way in terms of economic growth, in terms of the labor market indicators, and on the inflation front. And if anything, of course, at the bottom line, it just means that I'm going to quote Fed Chair Yellen on this one. And she says that when they finally do raise rates from emergency low levels, that would just be a strong signal that the U.S. economy does not stink, and it is strong enough to be able to withstand the pressures from having rates no longer at emergency low levels. And at the end of the day, isn't that a good thing? Thank you.